History doesn't repeat itself, but it does rhyme. And there's very few people who understand those patterns better than Jim Rickards. He understands how the past can predict what happens next in our economy.
So today we had Jim Rickards. Now, if you guys don't know who he is, he has some incredible books that, he wrote starting, I guess, 20 years ago, 10 years ago. He's been on the CIA and the Pentagon, the FBI. Like, the guy knows a lot of. He was dropping names about Fed chairs that he personally has met with. He is seriously an insider.
It was really interesting to talk to him because he has a lot of experience. I felt like he knows about the economy like what you know about real estate. Like, he's been around the block enough times to really understand it. And he brought up some stuff that was not even on my radar to be looking at when it comes to housing prices and rent and rate increases and all of those
I know that it flew by. And at the end, Daniel goes, I could have talked for another hour, like, easily, right? Because he's just so interesting.
Yeah, and you even said it. You want to go back and listen to this episode again just to take notes on kind of the things that he was saying.
This is one of those episodes where you guys need to in my opinion, really listen to it a few times, because I'm going to certainly do that. And I don't often say that about a lot of the people we interview. This is one of the ones that you're going to want to listen to really, really closely and study it.
Get out your pen and paper. Enjoy.
So it's my pleasure to bring in Jim Rickards. We just had Jim at Limitless this year. It's great to have you in person, Jim. Thanks for being here in Scottsdale, Arizona.
Thanks, Ken. It's great to be with you.
Yeah, you kidding me? Boy, I've read almost all your books. I cannot wait to talk to you a little bit more. What do you think?
Yeah, it's super exciting to have you on and excited to dive into all this monetary, macro economics.
Oh, yes, a lot going on.
There is. All right. So obviously there's a lot on people's minds right now, obviously, around the Fed. Let's just start banging away there. Like, I know you know all these people, right? These are characters.
Some of them, yeah.
You've hung out with a lot of them. So let's talk about the first one, the Fed's policy. Let's get into those. What do you like? What don't you like?
I don't like much, although they don't matter very much. It comes as a shock to people. The Fed is almost irrelevant to the things that really matter to investors. And I'll give you a very concrete example, because when I say that, it's like, well, wait a second. The Fed controls the money supply. They control the economy. It's the most powerful institution. None of that's actually true. They do a very good pose. That's their front. That's how they try to come off to the markets. But, investors care about short-term interest rate. Some investors in the mortgage business, you're a little more focused on a 7-year note or 10-year note. It's a pretty good proxy for a mortgage. But for a lot of leveraged investors, people rolling over, they're looking at the very short-term rates. So what are the best quality short-term rates? Well, a 4-week Treasury bill. That's it's liquid, it's safe, it's very short maturity. So a 4-week Treasury bill. There's another rate called SOFR, secured overnight financing rate. That's basically the repo rate. So those are the two most important interest rates that investors with short-term liabilities care about. Both of those rates are lower than the Fed funds policy rate. The Fed fund. So what is the Fed funds policy rate? That's the rate that the Fed actually sets. When the Federal Open Market Committee meets, they lower or just leave it alone the Fed funds policy rate. What are Fed funds? Fed funds it's money that banks lend to each other on an overnight basis. If they're short on the reserve requirements, they can, chase, JP Morgan can borrow from Citi or whatever. The Fed funds market has not existed since 2008. It hasn't, because the Fed printed upwards of $10 trillion of excess reserves. Well, if you have $10 trillion of excess reserves, you don't need to borrow reserves overnight. You got more than you need on the balance sheet of the Fed. So the Fed's setting a rate for a market that doesn't exist. Meanwhile, the markets that do exist are actually lower than the Fed funds target rate, which makes the Fed kind of irrelevant. Another way to understand it, Ken, is that the Fed is following the market down. Interest rates are going down, and Donald Trump and the White House, they're banging the table. The Fed's got to cut rates. They got to cut rates, lower interest rates. He wants to put new people on the Fed board to make that happen. So my advice to the White House is be careful what you wish for. Rates are coming down. Trump's going to get his lower rates, but that's not a good thing. The notion that that's stimulus is just not true. Low interest rates are associated with recession and depression. And we might have a recession coming on. We might be in the middle of one right now. You usually don't find out until some months after the fact. So Trump's going to get his lower interest rates. actual market rates are lower than the Fed funds policy rate, which makes the Fed kind of irrelevant. And by the way, I wouldn't be rooting for them. A healthy economy, interest rates are 4 or 5% because people can invest at 10, leverage 3 to 1, make 30% returns. I mean, you live this every day. But rates of 0, 1%, 2%, that's associated with a recession. So I'm not quite sure Trump gets that, but it's a good talking point in the meantime.
Yeah, I was wondering, thank you, by the way. I actually agree with almost all of those things. We just locked a deal at 4.74, this week.
Yeah.
And so, that's not your retail rate that you're seeing out there for single family or anything like that. It's funny how people hang on this quarter point, half a point. I just shake my head. It's irrelevant, right?
It is, because the Fed is not leading the market. They're following the market. So rates are coming down, but the Fed's not leading the charge.
Right.
So do you think that would stimulate the economy if they did bring rates down?
No, because rates are coming down anyway, with or without the Fed. The Fed, like I say, they're going to follow it. But it's not stimulus. What it means is that returns on investment are lower. The economy's slowing. When were the lowest? What was the longest prolonged period of really low interest rates in U.S. history? It's the Great Depression. And I talked to Ben Bernanke about this. It was went on for the better part of a decade, but rates were around 1 or 2%. Before he became Fed chair and was a regional reserve bank president and all that, Bernanke made his academic reputation on the study of monetary policy in the Great Depression. He's probably second only to Milton Friedman, and Anna Schwartz is one of the leading scholars on that. I think Bernanke was a terrible chairman of the Fed, but going back to the 80s and 90s, he was a pretty good scholar. And he said, the rates were close to zero, maybe 1, 2%, because nobody wanted to lend and nobody wanted to borrow. In a healthy economy, you've got people say, hey, I want to borrow money. I got projects. I want to make investments. And the banks are like, yeah, we're happy to lend because we're going to make some money. But that's when the interest rates start to go up because of the supply and demand. When interest rates are down around 2% or less, it means nothing's going on. Nobody's borrowing because they don't see the profit potential in the projects. Nobody's lending because they're worried about credit risk. And you're in a recession, if not a depression. So again, the idea that low rates stimulate anything is just not true.
So I know here we are, right? And everybody's wanting these lower rates, right? Because they, in my world, the real estate world, refinances have stopped. The buying has stopped. Mm-hmm. People are the people with those, call it non-fixed rate debt, or their loans are maturing or they're resetting and they can't buy the recap or the insurance or anymore to keep them down. And so there's kind of blood in the streets in the commercial market for sure,
right.
Multifamily, retail, office. So now, and they were so much lower, right? Not very long ago.
Right.
There's just no way. I mean, the 10-year is still at like 4.2 or something, and somewhere in there. And it's not going to change that much. And if you look at it, it really hasn't changed all that much. The spreads have, but mostly that's been good. What's interesting to me is that you made a really good point. My whole career has been somewhere in between 4 and 6% interest rates. Mm-hmm. My entire career.
Yeah.
And we've done great.
Yeah.
I think what's happened is people just come out of this 10-year period where it was really, really low, and they think that was normal, but those were gifts, right? So as you said that rates are actually heading down, is this going to bring us to stagflation? Is it going to bring us to a soft landing? What do you think?
I don't think it'll be stagflation, because stagflation is the combination of really weak growth with inflation, and we did see that in the late 70s. That was stagflation. You had 10% unemployment and 15% treasury rates. Let's say, wait a second, I thought they were inversely related. If unemployment was high, interest rates are going to be low, and vice versa. Not in the late 70s. I mean, you had sky high unemployment and sky high interest rates. That was stagflation. We're going to get higher unemployment, slower economic growth. It's going on all over the world. The U.S. is maybe the last one to feel the full impact of it, but Germany hasn't grown in 3 years. The UK is heading for a recession. Japan has had 9 technical recessions since 1990. What I would describe as at this point, 35-year depression. And economists don't like to use the D word, the word depression, because they like everything has to be a number you can fit into a closed form equation and so forth. Recessions are defined as 2 or more consecutive quarters of declining GDP. So they like that. It's got a math component to it. Well, what's a depression? People say, well, gee, if a recession is 2 quarters of declining GDP, a depression sounds worse, so that must be 10 quarters of declining GDP. No, that's not what a depression is, and I'll use John Maynard Keynes' definition. He said a depression is a prolonged period of below-trend growth with neither a tendency to get back to trend nor a collapse. Meaning, if your growth potential in the mature economy like the U.S., 3.25% is very doable, but you're growing at 2.2%, from 2009 to 2019, so end of the financial crisis to just pre-COVID, compound annual growth was 2.2%. But if your trend is say 3.5%, or say 3.25%, so think of it as a wedge. Here's the trend, and here's the actual. There's a wedge. That's lost wealth. That's now in the tens of trillions of dollars of lost wealth. So I would say, and I have said, we've been in a depression since 2007. A long depression, some people call it a silent depression. It doesn't mean that the economy has been declining the whole time. It does mean that we never got back to trend. In a typical recession, again, there's this trend line. So a recession comes and growth drops, okay, but it goes back to the trend, meaning there's a timing difference, but you didn't actually lose any wealth. There was because in getting back to the trend, you grew faster. So you went down 2 or 3%. You came out of it, you grew 5 or 6%. And you got back to the 3% trend line and you kept going on. What happened after 2008? We never got back to trend. We dropped a lot. That was a big technical recession. And we started growing again, but the new growth trend was far lower, a lower trend than the old growth trend. We never got back to that trend. So that lost wealth is permanent. And that's different. That is what a depression looks like. So I would say, we've been in a depression since 2007. Japan's been in a depression since 1990. It doesn't mean you're always in a recession, but your growth never gets back to what it was.
Now, is that kind of when you compare unemployment to underemployment?
Yes. I mean, unemployment is a good measure, but unemployment tends to be the last thing to fall apart. When you think about it, when you run businesses and you hire people, you spend a lot of time and effort hiring people. You do interviews and you vet them and background checks and do they fit in and all that. So once people are on board, you don't want to go firing a lot of people. It's like, hey, it took me a lot of effort to get those people. So firing tends to be the last thing that happens, but you do stop new hires, and new hiring hit a wall about 6 months ago. So unemployment is not skyrocketing. It's 4.2%. It's been going up, but not a lot. There's not a disaster in terms of unemployment, although we'll see some numbers coming up pretty soon that may start to show exactly what you're talking about. But new hiring hit a wall. But underemployment is something that's not very well understood, and it is a big deal. There's something called the labor, not to get too geeky, but there's something called labor force participation rate. And when they calculate the unemployment rate, if you're not working, if you're working age and you're not working, but you're not looking for a job, they don't count you as unemployed. You could be, sitting on the couch eating Doritos, watching a baseball game, but you're not technically unemployed unless you're out there looking. But there are a lot of people, it's like, what's the point of looking? There aren't any jobs because the new hiring dried up. So the labor force participation rate takes that into account. It says, okay, let's just do a simple equation. How many working age people are not working, and what's the working age population? So it's a simple fraction. You don't have to get into whether you're looking for a job or not looking for a job, et cetera. That rate right now is about 62.2%. But the all-time high was 70%, right around 2000, after a wave of, in particular, women coming into the workforce, and the participation rate going up. It peaked at 70. It's been going down for 25 years, but it's been going down very steeply recently, which means that if you took the people who are not in the workforce, they're in the workforce, but they're not working, they don't have jobs, but they're not counted as unemployed. If you added them to the unemployed, the unemployment rate would be around 8 or 9%. I mean, that number is like 8 or 9 million Americans not working, capable of working who are not counted as unemployed. So when you add that back in, the underemployed or those not participating in the labor force, and there's some legitimate reasons, homemakers, college students, there are reasons not to have a job and not be looking for one. But a lot of it are people who are just kind of sitting on the couch of giving up. Again, if you count them, unemployment is close to 9%. So this is consistent with this slow growth, depression, coming recession scenario.
So I was now that we're on the unemployment topic, we're seeing that less people are, once there's this natural attrition out, they're just not replacing.
Right.
I'm also seeing, like in Phoenix here, we have Waymo, right? And so they're replacing Uber drivers, Lyft drivers, because they're driverless. We're seeing coders that are no longer as necessary as they were. We're seeing paralegals no longer as necessary. I'm even seeing, or, call it, first, second, third year lawyers. Like this AI is really kind of taking things over, right. In a lot of ways. And I read your book, Money GPT, which is phenomenal, by the way.
Thank you.
But I wanted to ask you, right now we're at 4.2. I guess that's a reported rate, I think.
That's right.
But it seems much higher, as you just pointed out, with the labor participation rate. Where do you see, is this going to be the big kind of the black swan, I guess, if you will, that's coming?
Well, a couple of things. Trump famously fired the head of the Bureau of Labor Statistics who did these calculations. I don't know what took him so long. She was completely incompetent. There's no conspiracy. They're not making numbers up. It's not a fraud. I wouldn't allege any of that. But they have awful models. Again, they don't, how do they actually compute the unemployment rate? They call employers, but it's a sample. It's not every employer in the world. They couldn't do that. It's a sample, and they say, hey, did you hire anybody this month? Did you lay anybody off? And they have another survey. So that's called the employer survey. There's another survey called the household survey, where they actually call homes. They call individuals and say, did you get a job? Did you quit your job? Et cetera. In theory, those two should be about the same. There's some noise in there. They should be close. They're not even close. The employer survey, the one they use to calculate the unemployment rate, has shown not a lot of job losses, but the household survey shows huge job losses. So which one's right? Well, history shows that generally the household survey is more accurate, and the employer survey converges to the household survey over time.
Oh.
So get ready for a shock in the employer survey, and get ready for a spike in the unemployment rate. Number one, but the other thing is they do. When they come out with the new unemployment rate, we're going to have one in a couple of days, they revise the prior months. So they say this month, I'll make up a number. I don't know what it's going to be, but they'll say, we created 150,000 jobs. Unemployment rate went from 4.2 to 4.3. That's not a disaster. That's not a collapse. It's just part of a trend. Oh, but by the way, we went back and looked at July. We went back at June. And it turns out, that 100,000 jobs, now we lost 200,000 jobs, or the 300,000 plus jobs. It was actually only 150. Well, if you look at those revisions, first of all, they're huge. Secondly, it was 12 months in a row. Now, if you had one or two, I'd say, all right, noise, bad luck, whatever. But it's 12 months in a row. I was like, no, you're doing something wrong. Your model was flawed. And again, I'm not alleging fraud. I'm just saying that they won't fix these models. And so the idea that you fire the head of it, brought in somebody new who understands the problem I'm describing, that's a good thing. Well, hopefully we'll get better results. But when you look at the consistent trend of prior months adjustments, with every single month being lower than they told you at the time, that tells me that the models are badly flawed and you can't even rely on them. I actually look at the labor force participation rate because that's a much simpler calculation. It tells you something, but it's harder to get wrong because you don't have all these other factors going into it. The seasonality is a big one. Just tell me the number. I know it's summer and they hire more people in December because it's Christmas. I get that, but they're doing something badly wrong in that respect.
So I was going to ask before we jump off on employment, because it is confusing when you're looking at all the stuff you're reading in the papers. I saw, right before that woman, the BLS got fired, They adjusted like 252,000 jobs
Correct.
in 2 months or something.
Yep.
I was like, what is happening from the prior, reporting?
Mhm.
And so most people jump all over the issue. But when you're looking at this stuff, I mean, you've been doing it a long time.
Mhm.
What is it that you focus on? Is it the labor force participation rate?
I do look at that, and I think it's meaningful. The unemployment rate, I put less weight on because it's inaccurate. It's like I like data, and I put it in my analytical models and predictive models. But if the data is bad, then I don't necessarily want to rely on it. I look at a lot of very technical factors that come out of money markets and finance and capital markets. Again, some of them are a little geeky, but one of them, I'll give a simple example. It's called the swap spread. What's the swap spread? Well, swap in the bond market, I can buy a bond because I want to own it, but I finance it in the overnight market. So I'm receiving a fixed rate on the bond. They call it a 10-year treasury note. They're about 4.2% yield to maturity. So I buy a 10-year treasury note. I'm getting 4.2%, but I have to finance it in the repo market. And the repo market's about 3.2, 3.3%, on an overnight basis. We just keep rolling it over. So I'm making 4.2, and I'm paying 3.2 in the repo market. So I can do that trade without buying the bond. Just you're a hedge fund or bank. I'm another hedge fund or bank. I just say, hey, Ken, pay me fixed. I'll pay you floating. It's a contract. So I'm receiving the fixed rate. I'm paying the floating rate. And I'm getting the same yield, but there's no bond. What's the beauty of that? Well, number one, swap balance sheet. That's a swap, or it's a derivative. And so we're not using up any balance sheet, and it's just a little bit easier. Now, what's the swap spread? The swap spread is the spread between the fixed rate that you agree to pay me, in my example, and the actual rate on a 10-year treasury note. So normally it should be positive, meaning, if the 10-year treasury notes, again, say 4.25, I say, Ken, I like you, but you're not the U.S. Treasury. So you got to pay me, 4.4. You got to pay me a little higher rate than the treasury rate because you're not the U.S. Treasury. So that's the spread. It's a positive spread. So the fixed rate you're paying me is higher than the actual rate yield to maturity on the 10-year treasury note. That's a normal swap. Swap spreads are deeply negative. What does that mean? It means I'm willing to take a rate from you that's far less than what I could get if I actually owned the bond. Now, again, you're not the U.S. Treasury. I should get a positive credit spread from you, but I'm willing to take a negative spread and take the credit risk. Well, why would I do that? Well, you would do it if you think rates are going to crash. If you think rates are going to come way down, then maybe I'm getting 4.1% from you. That's going to look really sweet in a world of 2.5% treasury rates. So when you see negative swap spreads, which we do have, it means sophisticated counterparts are willing to take a fixed payment from a credit that by definition is not as good as the U.S. Treasury. And again, why would I do that? One, off balance sheet. Two, I'm okay with it because I think the treasury rate is going to crash. So right now, swap spreads are deeply negative. They're close to an all-time low, meaning negative spread. That is a very powerful signal with a very good track record of saying that the yields on the bond market are going to come down a lot very quick. Now, what does that mean for holders? Well, you get capital gains. When bond math 101, yields come down, the value goes up, and vice versa. So if the most sophisticated players are betting that yields are going to come down a lot, that means there are good potential capital gains on the 10-year treasury note. So it's a good time to own them.
Yeah. Is this similar to what happened to Silicon Valley Bank?
They had the almost opposite problem, which is they loaded up on treasury notes when yields were at 2%. And you go back during COVID, and you talk about mortgages. People don't want to sell their houses now because there are a lot of people out there with 3.25%, 4% mortgages who don't want to trade it for a 7% mortgage, so they just won't sell their house. So Silicon Valley Bank and a lot of other banks loaded up on treasury notes when they were maybe 2.5%, 3%. But then interest rates went up to 4.5 or 4.25, 4.5. Well, again, it's the inverse math. Interest rates going up, the value is going down. So they lost a fortune on those treasury notes. Now, you get into the accounting weeds. If I'm a bank and I have treasury notes on my balance sheet and they go down in value, do I have to take the loss? The answer is if it's in your trading account, yes, you have to call market to market. But if you're holding to maturity, you don't. You can keep it at historic cost. So they had massive losses in the tens of billions of dollars that they never reported because they took the view that we're holding these to maturity. Okay. But then they had a separate problem over on the other side of the balance sheet. They had deposits. Everyone's like, you have insured deposits. The amount of insured deposits at Silicon Valley Bank was about 3%. They had 97% of their deposits were not covered by FDIC insurance. They had big deposits. They had Cisco. They were crypto banks, venture capital startups, and so they all had their money in Silicon Valley Bank. Insurance is $250,000. You can have multiple accounts, so you can get it up there a little bit. But basically, these people had 10, 20 million or billion-dollar accounts that were uninsured. So once the panic started, people started getting their money out. It's a good old-fashioned run on the bank. You've seen grainy black and white pictures in the 1930s. You have guys in overcoats and fedora hats lined up in the rain to get their money out. Of course, it's too late because insiders already took the money. This was the same thing at the speed of light, meaning guys were like, they're on their phone saying, hey, I just took my money out. You better do it, before it's too late. And then that guy would get on his phone and withdraw the money and send it somewhere else. Within minutes. It wasn't hours and days. It was happening within minutes. So now Silicon Valley Bank is trying to pay out all these deposits, but they ran out of cash. So what do? Well, they had to start selling some of these treasury notes. Once you sell them, you're no longer in this hold to maturity category. You got to market to market, and they had multi-billion-dollar losses emerging overnight. And then they called Goldman Sachs, and Goldman was going to try to raise some capital for them, but they were failing faster than Goldman could do the raise, and they collapsed. So they had two problems. Number one, they were overweight, grossly overweight treasuries at lower yields that had lost money, and then their deposits were uninsured, so there was a run on the bank. Now, what did the FDIC and the Fed do? It's fascinating. So everything I just described took place on a Wednesday and a Thursday. So Friday night at 6:00, the Fed and the Treasury and the FDIC came out with a joint press release, and they said, you know what, depositors, too bad. This bank has failed. If you have an uninsured deposit, we're going to give you a certificate. We'll get back to you. We're going to sell the assets, liquidate the bank. I don't know if you're getting 10 cents on the dollar, 90 cents on the dollar. We just don't know. But here's an executive type certificate, and hang on to it. We'll get back to you. Well, this became the weekend of what I call the crybaby billionaires. Bill Ackman, all these guys, everyone in Silicon Valley, they're running to the White House saying, "You don't understand. These are all the venture capital startups. They've lost all their money. They can't pay their rent. They're going to lay off their employees. The technology is going to, fail. The companies are going to fail. We'll never get this technology." Leave aside the fact that 90% of them fail anyway, but that wasn't their point. So the White House got the message. They said, this is not just a bank failure and some lost deposits. You're going to take down a big slice of all the Silicon Valley startups because they all had their money at that bank. So Sunday night, 6 p.m., before the market opens the next day, the FDIC and the Treasury came out with two press releases, and they said, just kidding. All the deposits are insured in unlimited amounts. I was like, okay, so much for the Brisbane G20 meeting in 2014 when they said no more bailouts, we're going to have bail-ins. Like, oh, that's over. We're protecting everybody. And the Treasury created a facility. They said, if you're a member bank and your Treasury securities underwater, you can send them to us and we'll lend you 100 cents on the dollar. Even if they're only worth 70 cents or 80 cents, which they were, we'll lend you 100 cents on the dollar, 1 year, cheap interest rate, and see you in a year. So it's like, but they did that for the entire banking system, not just for Silicon Valley Bank. So I'm like, oh, gee, what just happened? The FDIC threw out the insurance limit for the entire banking system and insured every deposit. And the Treasury just threw out the mark-to-market accounting and collateral and said, we'll give you 100 cents on the dollar for everything. It's like, okay, I can't wait for the next banking panic because you're out of tricks. You guaranteed every bond and you guaranteed every deposit in the system, regardless of value, regardless of insurance. You've guaranteed the entire system. What are you going to do when there's another panic? What other rabbit can you pull out of a hat? And the answer is there isn't one. So just be ready for that world because. So
would that be like, do you see like a mass bailout situation potentially?
I think they already did it. I think that was the consequence of Silicon Valley Bank. Not every bank failed. You're right. But they effectively bailed out every bank by guaranteeing all the treasuries at par and all the insurance, regardless of insurance limits. So now, okay, you just bailed out the entire system. What are you going to do when there is another banking panic, which there will be? I mean, these things happen almost like clockwork every 7-10 years or whatever. They don't have any more tricks.
Do you think this is part of the? You write about the weaponization of the U.S. dollar, right?
Right.
And the Fed debt. You talk a lot about these
Yep.
in all your books. You think this is one piece?
It's a piece. Yeah. This is everything we just talked about with insurance and the bailouts and all that is not the same as the weaponization of the U.S. dollar. The weaponization of the U.S. dollar is going on in the national security arena. And a lot of the work I did for the intelligence community, CIA, Director of National Intelligence, was financial warfare. And I teach financial warfare at the U.S. Army War College, where the line between capital markets and, things that explode and bombs and stuff is no longer exists. It's just money and finance, and capital markets are just a weapon of war, and they're being used that way. And there's no better example. So go back to, as far as you like, 2006 or whatever, Russia was pumping oil. They were getting paid in dollars. They made billions, hundreds of billions of dollars. And you have to they were putting it in the reserves because they ran a trade surplus. And people say, all the, 70% of the reserves are in dollars. They're not actually in dollars. It's not like the People's Bank of China has pallets of $100 bills in the basement. They're denominated in dollars, but they're in securities. So what you do is you take the dollars you earn, you buy treasury securities. You can buy other things, but largely treasury securities, some government-backed mortgages, and you hold the securities. They're denominated in dollars, but they're actually securities. If you want dollars, you got to sell those securities. So where do you put the securities? Well, Russia they had $300 billion in U.S. government securities. They were on deposit at a company called Euroclear in Europe, which is a custodian depository. It's like DTC, and I think they have $47 trillion of securities on deposit. So Russia trusted the West to buy our treasury notes and trusted Euroclear as a custodian. So after the Ukraine war broke out, the U.S. and others, they froze those securities in Euroclear. Russia couldn't get them. We do that all the time. We freeze stuff. We're very good at it. But then they went a step further. They actually stole them. They actually converted them and started using that as money, as collateral for loans to Ukraine, which will never be repaid, by the way, to fight the war. So here, Russia trusted us, put their money in our securities. We stole the securities and used it to pay Ukraine to fight the war against Russia. So Russia was financing its side of the war with its own money, in other words. Fortunately for Russia, one of the reasons these sanctions have not worked is the head of the Central Bank of Russia, Vera Nabiullina. I'd say she's the only central banker in the world who actually knows her job. Beginning in 2009, she increased Russia's gold reserves, physical bullion, from $600 billion to about 600 metric tons to about 2,500 metric tons. And so they had 25% of their reserves in gold. So yes, the U.S. steals the treasury notes, but they had a lot of it in physical gold that you can't steal. It's not digital. You can't hack it. You can't cancel it. It's just there. In fact, you can melt it down and it's untraceable because it's not even a molecule. It's an element, atomic number 79. So that saved Russia because they had enough in gold and some other assets to weather the storm of the sanctions. I taught the class in April 2022. It was just 2 months after the war started. And it's they're handpicked. It's about 13 mid-career officials, but they're the future big brains. They might be lieutenant colonels or Navy commanders. I had the Top Gun F-16 pilot in my class once, but some civilians too, CIA, State Department, and other agencies. And they're like I say, the future 3-star generals or whatever. But they were very gung-ho at the time. And I said, look, the U.S. is doing these sanctions. These are the most stringent sanctions ever imposed. I'm an expert on sanctions. I said, they're not going to work. The Russian economy is going to outperform the U.S. economy. The ruble is going to be stable. It's not going to crash. And they're going to sell all the oil and gas they need to China and India and others. And this is going to have no impact on the Russian economy, but actually it will boomerang on us and hurt our economy in certain ways. Well, I got a lot of pushback in the class because, like I say, they're all warriors. And I said, that's okay. This is seminar style. You want the pushback. You want the dialogue. That's a good thing. So I teach the same class again the following year, May 2023. And I said, let me tell you what I told last year's class. Sanctions are going to fail. Russian economy is going to outperform. They're going to be fine financially, and they're going to sell the oil to China. Everything I said was right, and everything the government said was wrong. And they listened to me a little more carefully that time because sanctions don't work on a country like Russia. Sanctions work on a medium-sized country that doesn't have a lot of friends and doesn't have a lot of reserves. Yeah, you can punish that country with sanctions. But the idea that you can apply it to any enemy or any adversary and it works is not true. There are certain countries, Russia, China, India, among them, where the sanctions won't work, or Brazil, because they're huge economies, number one. And two, they have friends. They can trade with each other. They don't actually need us. So has the U.S. weaponized the dollar? Yes. Has it been successful? No. And so this thing gets into the BRICS and the Shanghai Cooperation Organization and the big parade in Beijing a couple of days ago. And all these countries doing whatever they can not to be under the thumb of the U.S. dollar. They have huge dollar reserves. They are in the dollar system. There's kind of no escape from it in the short run. But they're looking for ways out because we have weaponized it. And they're sitting there. If you're, Saudi Arabia, you're like, well, I see what they did to Russia. What if they don't like me someday? What if they wake up and decide to freeze my reserves? And so maybe I ought to be thinking about other things. And this is part of what's driving the price of gold higher. It's not the only factor, but it's one factor.
So it's really not just that we weaponized it as far as we froze the assets, but it was that we stole the money.
We stole the money. And, U.S. always says, you need to be in the rules-based international system. How many times have you heard that expression? Rules-based international system. Who writes the rules? We do. We write them to favor ourselves, number one. And then we break them when we feel like it, like by stealing the Russian security. So they're just like, okay, that's just monetary capital markets colonization of the world on your terms. We're going to come up with our own rules, and they are.
So in 2016, you wrote the great book, A New Case for Gold.
Yep.
And it's almost 10 years ago now, right?
Yeah.
So you were way ahead of this issue. And now gold's at almost an all-time high. You've seen the reserves from these other countries, right, stack up, even in China. And now gold's on a interesting run. And by the way, so is silver, right?
That's right.
Just whatever, 40
through 40, yeah.
Yeah. So is this the first indicator of people trying to get out of U.S. dollars?
To some extent, yes. And it's 2010 was an inflection point. So if we go all the way back to 1970, the United States had 9,000 tons of gold. We go all the way back to 1950. We had 20,000 tons of gold. We had almost all the above ground official gold in the world. By 1970, we were down to 9,000 tons. Where did those 11,000 tons go? Well, 2,500 to France, 2,500 to Italy, 600 to Japan, 700 or 800 to the UK. And those our trading partners ran surpluses. They took the dollars and bought gold. We shipped the gold, and they put it in their reserves, and they still have it. Germany was over 3,000 metric tons. But by the early 70s, there was a run on Fort Knox. The French actually sent a Navy vessel to New York to pick up their gold and take it back. They wanted, a naval escort to take the physical gold back to Paris. So that's why Nixon closed the gold window with our trading partners. It was meant to be temporary. He said temporary. You can find that speech on YouTube. He said we're temporarily closing the convertibility of foreign reserves into gold, and what they wanted, and I spoke to two of the people who were at Camp David that weekend. Ken Dam was later dean of the University of Chicago Law School, and Paul Volcker, who became head of the Fed, but he was Deputy Treasury Secretary at the time, so that's why he was there. But two of the people that I spoke to, both of them, they said, yeah, we thought it was temporary. We were going to have another monetary conference. We were going to devalue the dollar against gold, against other currencies, and get back to the Bretton Woods system. Well, they did have the monetary conference, Smithsonian Institution, December 1971. They did devalue the dollar or gold, a dollar against gold, from $35 an ounce to $38 an ounce, later $42. They did devalue the U.S. dollar against the other major currencies, Japanese yen, the Deutschmark at the time. There was no euro, about 12 to 16%, depending on the counterparty. But they never got back to the gold standard. They did all the stuff they said they were going to do. But what happened was, in the meantime, Germany was so sick of defending the dollar that they just went to floating exchange rates. They said, this is what the market decided, and we've never looked back. We still have floating exchange rates to this day. But from then on, central banks were net sellers of gold. The U.S. sold another 1,000 tons in the 70s. We went from 9,000 to 8,000, 8133 to be exact. In the late, and then we stopped selling gold. There's a reason for that. We don't have time to do it today, but maybe on some other podcast I explain why they just stopped selling gold at that exact number, 8133. But we got everyone else to do our dirty work. So the IMF sold 1,000 tons. The UK sold half their gold in 1999 at $250 an ounce, by the way. That was the bottom. That was like the 20-year bottom. Gordon Brown was the Chancellor of the Exchequer at the time. They call it Brown's bottom because he managed to hit the low tick. Switzerland sold 1,000 tons in the early 2000s, and then the Swiss were up in arms. They had a referendum, don't sell any more gold. The IMF sold another 400 tons around 2010, and that was it. They stopped selling, and then they became net buyers. The buyers were not the same as the sellers. They were still central banks, but it was China, Russia, Turkey, Iran, even though Iran's non-transparent, Kazakhstan, Mexico, Vietnam has bought a lot of gold, etc. So ever since 2010, central banks have been net buyers of gold. It has caused the price to go up somewhat. It's not the only factor, but the thing I like about it from an investment perspective, it's what I call an asymmetric trade, meaning you got a floor. Because central banks don't, they don't go wild. They don't want to disrupt the market. They'll call the dealers, the big banks. They'll put in standing orders, buy 10 tons a month, do it on, kind of steady Eddie, don't spook the market, etc. And they're smart. They'll buy a dip. So that kind of puts a floor under things. So when you own gold, you have limited downside, no guarantees, but you have limited downside because the central banks put a floor, but unlimited upside because it's going to keep going up, which I fully expect. And so that central bank buying is a driver. Supply and demand, good old-fashioned supply and demand. Supply has been flattish around 4,000 tons globally for the last 6 years, up and down a little bit, but pretty constant. But demand is going up for the reasons we just mentioned. So when you have flat supply and rising demand, that's a recipe for higher prices. And the third thing is we are nowhere near the retail frenzy stage that we saw in January 1980. We're not there. We got the factors we just mentioned. Fear of weaponization of the dollar, central bank net buying, flat supply, increasing demand. Those are all factors driving it up. There's a psychological phenomenon called anchoring, and people anchor on, let's say, $1,000 increase in the price of gold. So gold goes from $2,000 an ounce to $3,000 an ounce. That's a 50% gain, $1,000 an ounce. If you own, 50 ounces, you just made $50,000. But then it goes from 2,000, 3,000 is a 50% gain. But then it goes from 3,000 to 4,000, which is doing right now. That's another $1,000 gain. You made the same 50,000 on your 50 ounces, but it's only a 33% increase. Then it goes from 4,000 to 5,000, same $1,000 gain, but that's only a 25% increase. When you go from 9,000 to 10,000, that's only an 11% increase. That's like a good month. It's not like some phenomenal thing. So my point is, people are saying, hey, $1,000, I'm making all this money. And you are, but each $1,000 is easier than the one before because you're working off a higher base and it's a smaller percentage gain. And that's when the everyday retail investor wakes up and says, holy smokes, gold's 8,000, 9,000, 10,000, here you go. And then it could very easily get to 20,000, but that's the frenzy stage. But it gets easier because it's a smaller percentage and therefore easier to do.
So let's change gears a little bit and go into the housing market, right? So right now, housing affordability is at an all-time high.
Mm-hmm.
You know, rates are going to be going down, we think, next year.
Mm-hmm. Yep.
How do you think that impacts the housing market, or does it impact it at all, in your opinion?
Well, historically, it absolutely did, and you put your finger on it. Affordability, people, consumers buying residential housing. I'm not talking about investors in big tracts or commercial real estate. There's a little different, but someone getting a mortgage and buying a house, they're very focused on the monthly payment. I mean, yeah, they care about what the house costs and they care about good neighborhood and is it going to go up. Those are all factors, but they're very focused on that monthly payment because they have a budget and like it can't be more than a certain amount because they can't afford gasoline or food. So when interest rates come down on a certain mortgage, either the monthly payment comes down, or for the same monthly payment, I can get a bigger mortgage, and the bank will lend that to you. So that generally does stimulate the housing market and create demand for, as you suggest. The problem is that there are some weird things going on in the housing market that, you've been in it for a long time that we haven't seen before, which are these very large institutional investors buying up houses, not just developers putting in, 500 units, but BlackRock and others, I'm not picking on BlackRock, but they are a leader in this, buying up 100,000 units and going with no desire to sell those units. They just want to rent them out. And when you do that, you're basically taking real estate and treating it like a bond. It's like I invest a certain amount, I have a certain cash flow. I'm going to keep the cash flow generating. Well, that's what a bond is. It just keeps paying you interest or, stock. It'll pay you dividends. Well, once you do that, you're taking huge amounts of housing off the market. They're still there. People are living in them. They're paying rent, but they're not for sale. And so you would say, yeah, do lower interest rates make housing more affordable because the monthly payment? Yes, but housing can become less affordable because there's no supply. There might be physical supply, but it's not for sale. You have to be a tenant. Is that, some kind of 21st century debt slavery, like student loans? Maybe, but my point is that's a new factor that is causing housing prices to go up, even in a world where interest rates are coming down.
So a couple more questions before we roll out here, Jim. By the way, this is fantastic. Thank you very much. We have this new administration. Obviously, we've seen Trump's playbook before back in 2016. It's not exactly the same, but what do you see happening, during the rest of his presidency?
Well, I would say the playbook now is quite different. Trump, might have been he was a very successful New York businessman, commercial real estate developer, big management company and all that. He didn't know Washington. He said, I'm going to drain the swamp. He couldn't find the swamp. The swamp was a lot deeper and a lot darker than he knew. And you really had to, he made a lot of bad appointments. I've never seen a worse appointments process. So, and then just when he kind of found his, he gets steady on his feet, here comes COVID. And that was the last year of his administration. So he did some good stuff. The tax bill was a big deal, but basically it was a wasted opportunity. The Trump that you're seeing now and the economic program that you're seeing now, they worked on it for 4 years. They didn't wait till they won in November and said, oh, gee, we better figure something out here. They had it all nailed down. The Heritage Foundation Project 2025, it's 900 pages. I didn't read every page, but I read several hundred pages of the areas that are of most interest to me where, I write about it and so forth. They had this all figured out. Now, what's the rap on Trump today? Say, well, remember in February, March, it was, uncertainty, market uncertainty. We don't know what to do because we don't know what Trump's doing. And then by April and May, it was chaos. Was all this is chaos. He's 100% tariffs on China, then it's 20%, then it's 50%. Again, it just seems chaotic. Wrong. Trump has said stuff like that, so I'm not saying he hasn't been all over the place. But they have a very coherent plan, 3 pillars, if you will. They mesh very well. They're working on all 3 of them. They have an A-team. They finally got the appointments process right. I like Kristi Noem because she said you don't have to take your shoes off at the airport anymore. But there are 3 pillars of the Trump economic program. The first one is Scott Bessent's 3 arrows. He's the Treasury Secretary. Basically, keep deficits below 3% of GDP, keep growth, nominal growth, above real growth above 3% of GDP. Bearing in mind, if you get 2% inflation, your nominal growth is 5%, and that's what you need to think about in terms of debt. And pump 3 million barrels of oil per day over and above what we're already doing, and we're the number one oil producer in the world. If you do that, by the way, your debt situation is completely sustainable. Everyone's like, oh, $37 trillion in national debt, we're going bankrupt. Nonsense. You can't make sense of $37 trillion unless you put it in the context of GDP. It's like if you owe $50,000 on a MasterCard, is that a lot of money or not? Well, if you're making $20,000 a year and your interest rate is 30%, you're probably going broke. But if you're making $500,000 a year, you just write a check. So you can't judge whether that's a heavy debt load without looking at the income to support it. Same thing in national accounts. You can't think about whether 37 trillion is a lot of debt unless you look at GDP. Now, that ratio right now is 123%, 37 trillion of debt versus about 28 trillion of GDP. So you do that math, that ratio is 124%, all-time high. The question is it going down? Can you get it from 124 to 120 to 118? You want to get to 30. You certainly want to get to 60 and below 90. And it might take 20 years. I don't dispute that. But as long as you're heading in the right direction, the market will give you time. That's what Beston's doing. Second pillar is what I call the American System 2.0. You have to understand U.S. economic history. The American system was invented by Alexander Hamilton in 1790. It got that name from Henry Clay, who was a senator in the 1820s. It was supported by John Quincy Adams, Abraham Lincoln, William McKinley, Calvin Coolidge, Dwight Eisenhower, Teddy Roosevelt, etc. And it basically involved high tariffs. There was more to it. High tariffs, infrastructure investment, transcontinental railroad, the telegraph, telephone, all these systems, etc. Rural electrification in the 1930s. Get the government and the private sector building out the infrastructure. High tariffs because it creates high-paying jobs. It's like Henry Ford famously gave his workers a $5 raise, and the other oligarchs said, Henry, what are you, crazy? Why are you giving your workers a raise? And he said, I want them to be able to afford to buy my cars. And so that's what tariffs do. Tariffs do not get passed on to the consumer, by the way. They're not inflationary. The guy who writes the check, the importer at the port of entry, writes the check to the Treasury. But then the question is, who bears the cost? They push it back up the supply chain to the exporter in China. And says, hey, you got to lower your costs, pay your workers less, or, et cetera. So it does not get passed along to the consumer. So Trump is recreating this system, which worked, by the way, from 1790 to 1962. That's how America grew strong. That's how the American economy grew, with high tariffs. Civil War. It was about a lot of things, but it was partly about tariffs. The South were exporters, so they didn't want tariffs because they didn't want other people putting tariffs on their goods, cotton and tobacco and so forth. The North were industrialists. They loved tariffs because it protected their industries. Well, guess who won the Civil War? It was the North. And so it's always been part of U.S. history until the globalists kind of took over in the 1990s. They're gone. They're done. Tariffs are back. Peter Navarro is the main architect of that. I've spoken to Peter about this. The third leg is the Mar-a-Lago Accord. This is Stephen Moran. No one's ever heard of, but he's a brilliant scholar. He's currently chairman of the Council of Economic Advisors, but he's just been nominated to be on the Board of Governors of the Federal Reserve and had his hearing today, and he's going to be confirmed. So now you have a White House guy going on the Fed board. Trump already has a couple appointments, and he fired Lisa Cook, and he'll get another one with her. What's going on there is Trump's kind of taking over the Fed. Everyone's up in arms. You're breaking down the wall between the Treasury and the Fed. When the Federal Reserve Act was passed in 1913, the Secretary of the Treasury was a member of the Board of Governors. They used to meet in the Treasury building. So there's nothing new. Again, everything Trump's doing has been done before. He's not upsetting the apple cart. He's going back to what worked. And then there's more to the Mar-a-Lago Accord about, don't you dare devalue against the dollar. The dollar is going lower, but it's being engineered by the Treasury. This is not a flight from the dollar. This is what the U.S. wants. And James Baker did it in 85, and Nixon did it in the 70s. So 3 arrows, American System 2.0, Mar-a-Lago Accord, well thought out, well directed, highly integrated. They know what they're doing. This is very good for America. Having said all that, we might have a recession this year for reasons that have nothing to do with Trump. Trump will bring us out of it in 2026 and beyond, but we still got to unwind the legacy of Biden and government deficits and everything else.
So, there's been a lot of uproar about tariffs, and a court, just ruled it not legal. So it's going to go to the Supreme Court.
Right.
Do you see that being an issue, or is that just hype right now?
Look, it's a real legal issue. It matters, and I pay attention to it. But the pattern since January, since Trump took office, executive orders, legislation, proclamations, etc., all these things, whether it's Harvard University or tariffs or whatever, there's a statute called the International Emergency Economic Powers Act of 1977, IEPA. It's got a clunky name, but that's what it is. That gives the president dictatorial powers, in the good sense of the word dictator, on two predicates. Number one, is there an economic emergency, and does it have an international connection? If those two things are true, the president can freeze, seize, don't say please. I mean, the president can be an economic dictator. That's what Biden used for all the sanctions on Russia. That's what Trump is using for tariffs and a lot else. Now, but they've done a lot of other things, education, student loans, immigration, deportation, you name it. Every one of those things has been challenged in court, and the federal district court judges, because that's where the federal system starts. You got these rogue judges, they're Obama, Biden appointees, they're issuing injunctions, they're telling Trump to stop, etc. The Trump team are then appealing them to the Court of Appeals or the emergency docket at the Supreme Court. Trump is losing 80 or 85% of the cases at the district court level because the judges are nuts. They're winning about 85% of the cases at the appellate level, including the Supreme Court. Not everyone, but the vast majority of them. So you have to let the system play out. So to your point about the tariffs, yes, a federal district court judge said that president doesn't have the authority under APA to impose tariffs. A circuit court actually agreed with that, but that's going to the Supreme Court. In my view, the Supreme Court is going to reverse that. They say, well, the word tariffs is not mentioned in AIPA. Yeah, neither are drones. But, we put sanctions on Russia so they couldn't manufacture drones. Just because it's not mentioned doesn't mean it's within the scope of the emergency powers, number one. As far as separation of powers are concerned, AIPA says if the president does something and the Congress doesn't like it, the Congress has 90 days to overrule the president. So there is a check. This is not unlimited power. If the Congress wants to go along with it, they don't have to do anything. And so why are the courts, when the executive branch and the legislative branch have a statute and they work together and there's a check on the president in the form of congressional disapproval, why do the courts have to be involved at all? So I think it's going to be reversed.
For those that are listening, what are some actionable things that they could be doing that you're thinking about, places to be financially, in the next few years?
Sure. I always recommend a 10% allocation to gold, and people go, well, Jim, you're very bullish on gold, which I am, and I own gold. Why not 50%? 10% is plenty. If it performs the way I expect and goes up by a factor of 5 or 10, you're going to be very well protected. If it doesn't, you won't be hurt that badly. I think it's going up. I wouldn't recommend it. But if it went down 20% on 10% of your portfolio, it's a 2% hickey, not the end of the world. But in my view, we're at the beginning of the third great bull market since 1971, and we could see this go up 2,000%. So I recommend that. I've always recommended a large allocation of cash, maybe as much as 30%. And people go, oh, what are you talking about? You don't make any money on cash. Well, 5 years ago, that was true. Interest rates were about 1%. But today you can get 4% on cash. So you do get a return. But that's not the main benefit of it. Cash is the opposite of leverage. Leverage accelerates your gains, but also accelerates or amplifies your losses. So it makes the portfolio more volatile. Cash, you don't make a lot of money. You don't lose any money. And so it dampens. So if you have volatile assets at other ends of it's called the barbell, cash will reduce the overall volatility so you can sleep at night. but it has an even more powerful characteristic, which is embedded optionality. People don't understand this. If you have cash, if the markets crash and you have cash, everyone else is selling their assets, at fire sale prices, trying to get out. If you're the one with cash, you can sit back, watch the thing crash, and then go shopping. So it's kind of an at-the-money call option on every asset class in the world. That has enormous value. So don't underestimate the optionality of it. Stocks, yeah, I have a slice of stocks, but I see people go, Jimmy, you own gold, and how do you sleep at night? I'm like, you're 90% in equities. How do you sleep at night?
Yeah, no.
So that's a problem. So have a slice of equities. I'm not anti-stock market, but I would be lightening up on that, maybe increasing cash. By the way, who has 1/3 of $1 trillion in cash? It's Warren Buffett, the greatest stock investor of all time. Okay, maybe, but he's got 1/3 of $1 trillion with a T in cash. Why? He sees what we see. He sees what I'm talking about, which is, and he's getting ready for it. And and then I like treasury notes. Now, 10-year treasury note, a little volatile, seasoned to taste. You might like a 5-year note or a 2-year note. But if interest rates come down the way I expect, and I believe they will, you're going to have really sweet capital gains. You can either keep it and take the yield, which is nice, or sell it at a significant capital gain, because when interest rates come down, the value of the note goes up. So, yeah, equities, treasury notes, cash, gold, real estate, alternatives, technology investments, etc. I have, I've invested in a certain number of tech companies. Yeah, you win some and lose some. That's a volatile business, but that is a really good diversifier. So that's what a good portfolio looks like.
It's funny you bring up Buffett, because he just last week made huge investments in Lennar and D.R. Horton.
Yeah.
As you probably saw.
Sure.
Huge numbers,
yeah.
right? Hitting them while they're down, right? Because they're doing those rate buy downs, and their stock price is way down, and their net, their net per house is way down, and supply is down, and interest rates are up.
But
so it's a good, he's actually positioning right now for what I think is going to be an incredible run in the next few years.
I think it's right.
Yeah. Well, Jim, incredible conversation. Thank you so much. Can't wait for dinner, by the way.
Thanks for inviting me. Yeah.
Thank you very much for coming out to Arizona.